Okay, so I have a friend and I will spare him the embarrassment of mentioning him or mentioning his name here. And he always seems to buy and sell stocks at the wrong time. I bet you have also such friends. And he watches a lot of TV and get excited at the prospects of becoming rich quickly from any publicly traded company that happens to make the news. And it struck me after having watched my friend losing plenty of money throughout the years that there are many others who get involved in the markets the same way. They hear a hot tip, listen to a broker who pushes some brokerage inventory, or watch the top performer list like the top 20 we have on their computers and decide upon the top 20 to get into a trade without putting any more indicators or thinking into it. And as a trader, this is the type of person I would like to find. This is the kind of person you want to find. We want to find the consistently wrong trader and take the opposite position. This will obviously lead to successful trade for us. Now, since I cannot share my friend's contact information with all of you, sorry guys about that, I will have to share a way to find when the uneducated trader enter the market. Now, most of you may have read trading books. Alright, most of you probably read trading books that state that increasing volume is good for the continuation of the trend, and this is true. But there becomes a point of saturation where the markets cannot sustain the trend. Think of what makes prices rise. There has to be a buyer and seller for every transaction, for any share that is being traded. However, when there are many buyers chasing a limited amount of supply due to a limited number of sellers, what the price is going to do? The price is going to rise because the buyers outbid each other to claim the shares. This will continue until most people who were interested in buying shares are already in or have stopped bidding as shares become too expensive for them. So at some point of time they don't like the stock anymore because it got too pricey. Now the market is saturated with too many worried holders of shares who will sell to take profits out of the table, to realize profits. Unfortunately for them, at this time there are few buyers for their shares and they become forced to sell at lower prices in order to attract other buyers. Eventually, all of the supply will be dumped onto the market and prices will start to rise as buyers once again outnumber sellers. So this is a process that is all the time we can see in the market. This is what happens behind the scenes in all markets, and we see this action causing supply and demand levels. The interesting thing about this price action, the price movement, is that the amateurs typically enter into the trend after it has already been moving. Right? After it has already been moving. And this seems counterintuitive, as you wouldn't walk onto a car dealership and offer them higher than sticker price or pay extra at the drive-thru just because you love the taste of a double animal style burger. However, when it comes to trading and also in investing, most amateurs look to buy after a large rise in price or sell after a large drop, and we can see this over and over in the charts. And for example, here in the chart, after a decline in the share price, we can see here a large red bar at the bottom. Usually, you know, this is the place when this is the place where the amateurs are selling after the price has already collapsed. For example, a lot of amateurs are getting shorts here, although this is a good place maybe to start thinking about buying the stock. Another example on this on this chart is this green bar. All right, this is a very large green bar, and usually you are going to see amateurs buying this green bar. And you know, this is when we see such a green bar after a huge run in the price of the stock. This is a good sign for us that probably the action is overdue. Probably the action is done, and there is nothing more for the stock here to do. In this example, the stock was able to push higher after that, but you know, it doesn't worth the risk. All right. So from a point of risk reward, it doesn't worth us to put our money on such a candle after a sharp rise in the stock. As a professional trader, you know, I want to trade against these amateurs and in the same directions as the Wall Street professionals. And if you notice in this chart, the price will often move far and fast at the beginning of the trend, as only the professionals are entering the market. And this is viewed on the chart as large candles, all right, large candles, but opposite to what we saw in the previous slide, these large candles comes at the beginning of the trend, not at the end of the trend, at the beginning of the trend. So this is early in the trend. We can see a very big, a very large green candlestick with a rise in the volume. All right, we have the same exact candle, couple of candles after that, but this is a long candle after a run. So this is the entry of the amateurs, while the first one is the entry point for the professionals. All right, so we always want to trade with the pros, and by buying at a strong demand levels and selling at supply levels, you will be trading with the pros. And we want to use long bars as entry point, but only if this is at the start of a trend. So the takeaway from this lesson is that when we trade, we must look for the highest probability entries at supply or demand. Often our trades will be confirmed immediately after we enter with large candles and professionals entering. We can help to time our exit at our target supply or demand when we see large candles signaling the amateur's entrance into the trend. So, for example, if we have a short position for, I don't know why, from in other strategies, we are short sellers, we have a short position on this stock, and as you can see, the stock is collapsing, is going downwards, so we are making money, good money, and you think, all right, where am I going to get out? Where is the greatest point to get out and take all the money from off the table? This is the point. When you see this large red candle, not at the start of the trend, but at the end of the trend, after a long sequence of red bars, all right, well in the downtrend. Okay, let's move on, and as we can see, this large red candle is just a demand, because if I'm just going to open the charts, and usually I want to see, not to be just focused in this trading day, but to, just to get a very broad view of how the stock traded in the last 3 or 4 days. Here we can see that the large candle was just at a demand, around the demand area, and this is a demand area. All right, a couple of days before, this was a support zone for the stock, and from there, this is, by the way, this is Cisco. From there, Cisco went up sharply. So we are not just, we are not just exiting a position at this point. We also, we also putting into our analysis what happened to the stock from the demand and supply zones in the past. All right. So trade with professionals. You should find the fool. You should take the opposite position of the fool. As Ramesh said here at the poker table, if you don't know who the fool is, probably it's you. So you should learn the tactics that professionals use to trade and avoid common mistakes of the amateurs. And until next time, thank you very, very much for being here with me for these presentations. If there are any questions, I'm staying here to answer them, and I wish you all successful trading. Thank you all. Max, you can download the slide. You can just email me. All right, it's at the bottom of the screen, shlomo@trend.co.uk, and I'll just send it to you, send it to your email. So you are most welcome.